On February 14, 2007, a relatively new Federal Reserve Governor, Kevin Warsh, took the stand before the House Financial Services Committee. At just 35, Warsh was the youngest Fed governor in history, nominated by President George W. Bush. His testimony on monetary policy challenges came at a peculiar moment. The early tremors of the subprime mortgage market were just beginning to register. While not yet a full-blown crisis, market participants hung on every word, scrutinizing his remarks for clues about the Fed's stance on the burgeoning housing market concerns and potential inflation risks, even as the broader public remained largely unaware of the impending catastrophe. This moment, a seemingly routine congressional hearing, perfectly illustrates a profound truth about global finance: the numbers don't move markets. The words do. We're talking about a phenomenon where a carefully chosen phrase, or even a subtle shift in tone from a central bank official, can trigger a cascade of decisions that gain or erase trillions of dollars in seconds across global financial markets. It's a testament to the immense power of anticipation and collective belief, demonstrating that the most potent economic force isn't just money itself, but what everyone believes is about to happen next. Why does the Federal Reserve, specifically its Federal Open Market Committee or FOMC, wield such disproportionate power? As the central bank of the United States, the Fed dictates monetary policy, directly influencing interest rates, money supply, and ultimately, inflation. Its decisions ripple through everything from mortgage rates to corporate borrowing costs. Market participants, ranging from individual investors to high-frequency trading algorithms, hang on every official statement and testimony, parsing them for clues about future policy direction. This intense scrutiny elevates central bank communication to a critical market driver, more so than many realize. Kevin Warsh, during his tenure from 2006 to 2011, was known for his clear, direct communication style. In the highly nuanced world of central banking, where even slight deviations from boilerplate language are amplified, Warsh's straightforward approach distinguished him. This characteristic meant his remarks were often less prone to misinterpretation but could also carry significant weight. His testimony in early 2007 was a crucial opportunity for markets to gauge the Fed's understanding of the emerging economic landscape, particularly regarding the health of the housing sector, long before the Great Recession took hold. Central banks employ a tool called forward guidance, communicating their future policy intentions to shape market expectations. This mechanism is designed to provide clarity, but its efficacy relies entirely on how markets interpret the language used. The more precisely the Fed can guide expectations, the more stable the market response to future policy actions might be. However, any perceived ambiguity, hesitation, or unexpected phrasing can have the opposite effect, creating significant market volatility. This strategic use of language underscores the idea that belief about future actions is a powerful economic determinant. Perhaps the most iconic example of words moving markets is the 2013 taper tantrum. Then Fed Chair Ben Bernanke merely suggested that the Fed might begin to slow down, or taper, its quantitative easing (QE) program later that year. This single statement, spoken without any immediate policy change, triggered a global market panic. Bond yields surged, the S&P 500 dropped, and emerging market currencies plummeted. It wasn't an action, but the anticipation of an action, communicated through words, that caused an estimated multi-trillion-dollar shift in global asset values. This was a stark demonstration of expectations power. Markets, particularly today's hyper-connected ones, don't just react to the facts presented, they meticulously analyze the way those facts are delivered. A slight hesitation, an unexpected emphasis, or a deviation from previously used vocabulary can be interpreted as a significant signal. Investigative journalists often read between the lines, but in finance, algorithms and human traders are doing the same at lightning speed. This phenomenon points to insights from behavioral economics, where irrationality and emotion play a significant role. The perception of uncertainty or conviction can be more impactful than the substance of the statement itself. The advent of high-frequency trading and sophisticated algorithms has dramatically amplified the market's sensitivity to central bank communication. These programs are designed to scan transcripts, speeches, and news feeds for keywords and sentiment, executing trades in milliseconds. A shift in a single word can trigger automated buying or selling programs across exchanges worldwide. This means that a subtle change in language that might have taken hours or days to fully digest in previous eras now causes instantaneous, widespread market convulsions, turning nuanced verbal cues into immediate, tangible financial consequences. The concept of animal spirits, first introduced by economist John Maynard Keynes, describes the human emotion and instinct that drive economic behavior. In the context of central bank communication, investor sentiment is precisely this collective animal spirit at play. When a Fed official speaks, markets are attempting to gauge the collective mood, the confidence, or the fear that will influence future investment and spending decisions. It's less about the current interest rate, and more about whether investors believe the Fed will raise or lower it soon. This belief dictates capital allocation, driving trillions in market movement. This phenomenon isn't exclusive to the Federal Reserve. Central banks across the globe, including the European Central Bank, ECB, and the Bank of Japan, BOJ, operate under similar principles. Their communication strategies, forward guidance, and even the personalities of their leaders are all meticulously monitored. A statement from the ECB president can send the euro soaring or plummeting, just as the BOJ's outlook affects the yen. This creates a global echo chamber where the words of a few influential individuals in key financial centers hold disproportionate sway over interconnected international markets. The impact of central bank words extends far beyond the stock market. Bond yields are particularly sensitive, as they directly reflect expectations for future interest rates. A hawkish statement from the Fed, implying higher rates, can cause bond prices to fall and yields to rise instantaneously. Similarly, currency markets react profoundly. If a central bank signals tighter monetary policy, its nation's currency typically strengthens as investors seek higher returns. Conversely, dovish remarks can weaken a currency. These shifts represent trillions in value changing hands, purely based on communicated expectations. Even commodity prices, from oil to gold, feel the ripple effects of central bank rhetoric. Commodities are often priced in US dollars, meaning that a stronger dollar, triggered by hawkish Fed talk, makes them more expensive for holders of other currencies, potentially dampening demand and lowering prices. Gold, traditionally seen as a hedge against inflation and a safe haven, reacts inversely to interest rate expectations. When rates are expected to rise, gold often falls, and vice versa. This demonstrates how a single speech can connect the abstract world of monetary policy to tangible global resources. Economic theories like rational expectations suggest that individuals make decisions based on all available information and their understanding of future policy. However, the reality of market reactions often veers into the realm of animal spirits and imperfect information processing. While economists strive for clarity, the inherent complexity of global finance means that even the most meticulously crafted statements are subject to diverse interpretations. This divergence between theoretical rationalism and actual market behavior highlights why communication isn't just about facts, but about perception and the complex psychology of the crowd. The leadership of subsequent Fed chairs, including Ben Bernanke, Janet Yellen, and Jerome Powell, has further cemented the critical role of central bank communication. Each has navigated periods of immense economic challenge, from the Great Recession to the COVID-19 pandemic, using their words as a primary policy tool. Their public addresses, press conferences, and testimonies are meticulously prepared, knowing that every syllable will be dissected by analysts, traders, and algorithms worldwide. This ongoing legacy underscores that central bank communication is not merely an auxiliary function, but a core instrument of modern monetary policy, shaping economic outcomes directly. Ultimately, the story of Kevin Warsh's testimony, and indeed the broader narrative of modern central banking, is one where the real power lies not in the present numbers, but in the future expectations. When Warsh spoke in 2007, his words contributed to the complex web of market sentiment that was grappling with nascent economic distress. Fast forward to today, and that principle holds true. The economy is driven by what businesses and investors believe is about to happen next, and central bankers, through their carefully chosen words, are the primary architects of that collective belief. It's a delicate dance where perception is reality. From Warsh's nuanced remarks on the cusp of the subprime crisis to Bernanke's taper tantrum, and through the current era of inflation management, the consistent theme is clear: the words of central bankers are arguably the most powerful economic force on earth. They shape investor sentiment, dictate trading strategies, and ultimately, determine the flow of trillions of dollars in global capital. It's a testament to human psychology, algorithmic speed, and the sheer interconnectedness of our financial world that a few sentences, carefully delivered into a microphone, can still send ripples, or even tidal waves, across the entire planet.